today we're talking to two investment managers with nearly 70 years of investing experience between them. They've worked at businesses such as Templeton, West, LB Mellon, Scottish Widows, Aon Investment Consulting and Edinburgh Partners. And they're now responsible for managing the £110 million of assets that is the Global Opportunities Trust. I'm delighted to welcome to the channel Sandy Nairn and Alan Bartlett. Gentlemen, welcome to the podcast.
Thank you.
Thank you.
So before we start talking about the trust and the portfolio and how that's positioned, perhaps just give the viewers and listeners a quick introduction to who you are, how you got into fund management and how you've ended up working together.
So for me, it was probably a sequential series of, of accidents. I did a first degree in economics and engineering and then was offered a scholarship to do a PhD. One of my economics lecturers asked me if I wanted to go and work as an economist, which I did, and then a year into that he said, why don't you try fund management, I think it might suit you. There happened to be an investment firm in Glasgow called Murray Johnson, who I joined, and I was there for 4 or 5 years, and then subsequently somebody I'd worked with there was at Templeton, said, why don't you come and talk to us at Templeton, and that was me in the investment management profession. And
that was nigh on 40 years ago. You've been
85 I started,
Yeah, so you've been doing it for a while, a bit of experience now.
Yeah, well, yeah, it's experience. I mean, what's interesting is that it's continually changing.
Yeah.
So how much experience benefits you, I'm never entirely sure, but the fact that it's continually changing means it's continually interesting.
Yeah. And Alan?
Yeah, not that dissimilar. I did a degree in economics. Actually didn't do any of the finance units because I thought environmental economics was far more interesting than finance. Then didn't have the money to do a PhD in environmental science, so was trying to find a job and got a job in Glasgow with an investment consulting business. Wanted to be in Glasgow, so I was chasing a girl basically. And then, I found it fascinating, and that was me. My career is sort of unusually diverse, would be one way of putting it, in that I've worked in investment consulting, I've run fund of hedge funds, multi-manager funds, started up boutiques, bought stakes in boutiques, helped run a private equity fund, been CIO of Templeton Global Equity Group for a while, working with Sandy, and now sort of back to the business that I sort of founded back in 2009 to help Sandy managed the Global Opportunities Trust.
So Templeton's where you first started working together, and then subsequent to that, or you've known each other longer than that?
Yeah, I think probably around 2000, isn't it?
Yeah, I think I first met you when you went to Scottish Widows.
Yeah.
And then I can remember it very clearly because Sandy had this sort of grand vision for what he was going to do with that business, and it was a great plan. And I think the first time I met you, I pointed out that you were reporting to an actuary, and that actuaries didn't understand investment management, so that it wouldn't really work.
Yeah, I'm not going to comment on that.
I'm going to comment on that. So you started Goodhart Partners 2009, but you were Edinburgh Partners back
2003.
Then? Yeah.
I started it. Yeah.
And then the two of you got together and are now running the Global Opportunities Trust amongst other boutiques that you invest in, etc. Is that right from the Goodhart Partners perspective?
Yeah, well, I think Sandy and I had sort of got to know each other over a 20-year period, and got, I guess, became each other's confidants over time would be one way of putting it. And then Sandy sold his business, Edinburgh Partners, to Franklin Resources, and went to be chairman of Templeton Global Equity Group, alongside running Edinburgh Partners, and he essentially wrote me in to be CIO of Templeton Global Equity Group. So we've been sort of working with each other more progressively over quite a long time period. But I think the time when we say that we really worked together on the Global Opportunities Trust started when some changes to the strategy were made in 2021. We've been working together under the same legal entity from 2019 and talking, but there was an inflection in the way that the trust was managed in 2021, which I think you can look at as being when Sandy and I tried to fuse both of our brains into one portfolio.
Okay, so 2021. You've now tried to both of you do the same work on the same portfolio together. That's a Global Opportunities Trust. It's unusual. It's a self-managed trust. Just talk us through how that's structured, and it's unusual because it doesn't measure itself against benchmarks and things. It's doing some stuff that's a bit different from quite a lot of your competitors, isn't it?
Yeah, so if you go back in history, it was the first fund that Edinburgh Partners launched, and it was the investment objective was set to try and give the necessary amount of flexibility, because you didn't want to be forced into investing in particular companies, sectors, etc. The problem that we had was that post the financial crisis, with the way markets had gone, that the flexibility we thought would have been enough was no longer enough because of where markets had got to.
Okay.
So we needed to change the investment objectives to be able to manage the money and get the structure of portfolio that we wanted. And part of that was also the nature of the client base within it. We've both got most of our savings in it.
Yeah.
And the feedback from a lot of the shareholder base was they wanted it continued in a particular manner, which really necessitated it becoming self-managed. So there was a lot. The board was kind of reconstituted with a very talented, thoughtful board whose investment outlook and how something should be run is aligned.
Yeah.
So what we've got now is a trust with the flexibility necessary to deal with the market conditions we've got, and then what we've been doing, and particularly Alan, because he and I have got kind of different backgrounds, and although there's a lot of overlap in skill set, was to try and fuse those together and then bring in the incremental resources to take advantage of what we think is going to happen.
Yeah, I think the basic idea is to run a strategy the way that you'd want to run your own money, which is that, in simple terms, when you have lots of good ideas, when markets are cheap, when the potential return is really attractive, you should be willing to tolerate risk and go for the return. But at other times things are expensive, you can't find great ideas, you shouldn't be forced to take market risk. I think if you look at the sort of productization of our industry, there are lots of strategies that permanently run with very low absolute risk, and then lots of strategies that run permanently full market risk, a conventional sort of long-only global equity strategy. And the ideal thing really is to be able to move between the two depending on the opportunity set. And historically that's not been a great commercial strategy because people like to bucket things.
Yeah.
Our view in simple terms is that you need that kind of flexibility on a forward-looking basis because some of the key drivers in markets are changing, and that whilst in many ways it's been sensible to be sort of long only and patient, as broad as possible, by index funds and ETFs on a forward-looking basis, I think many of the things that have supported that are changing, and that the key really is to be able to focus on specific investment opportunities that offer really attractive returns and have that flexibility to not be forced to invest in things just because it's in a benchmark index or because clients don't want you to move into cash and away from the market.
So touched on it to a degree here, but in terms of your investment objective, you're not setting out formally to track a benchmark. You're not I'm going to match the MSCI global returns or anything. That's not what you're setting out to do on day one with this strategy. What you're setting out to do is to preserve capital in poor times and take advantage of market weakness to grow. Is that a way of describing it?
That's probably a better way of saying what I just said.
So, but from an investor's perspective, if someone's to put their money in, you've just both said you put most of your personal wealth in. If they were putting their money in, I suppose what I'm asking is how would they expect you to perform in different market conditions, and how does that work from a portfolio construction perspective? Because they're not going to get exposure to the S&P 500 or Nvidia, because that's not what you're looking to buy into, is it?
Well, not today.
Not today.
I mean,
right.
I think Alan said, but you sort of come back to them. There's a time to preserve capital where that's your focus, and then there's a time to seek return, and then there's a whole series of gradations in between, and we're taking those decisions. That's part, and then that's kind of round one of the decisions, and round two is where you actually, which derives from where the value is, where you see opportunities. we're also making those decisions. But there's two sets of decisions here, which are interlinked with each other.
Maybe another way of thinking about it is over the last 30 years or so, broad equity market returns have been about 10% per annum nominal, sort of 5 to 6% real after inflation. There's a big difference between a kind of rate of return that makes sense as an investor, personally, that you want to make a return on capital, and just predicting that the S&P 500 is going to go up by 10% per annum for the next 20 years. And so, if we do a good job, we'll compound returns over the long term, I think, that are in real terms that are consistent with equity markets. But sometimes be significantly better than that, and sometimes significantly worse. Our bias is the compounding, so don't force yourself to take lots of risk when you can't find things that are fundamentally attractive and cheap. And in a lot of environments, in a lot of investment strategies, you actually have to do that. You have requirements that you have to be 95% plus invested. You have clients that think about risk in terms of tracking errors, so the extent to which you deviate from an index. So in that sense, if a market goes down 30% and you go down 27%, you've done a great job. Well, to us, that's not doing a great job, because
you've lost 27%.
You've lost 27% of your money. And sometimes that can happen. Markets are volatile, but we think you can tilt the odds in your favor by sensibly adjusting the risk in a portfolio over time, depending on the opportunity set. Today and for the last few years, we've been pretty cautious, but we're compounding at a relatively attractive level over the last 3 or 4 years, and with very significantly lower volatility than equity markets. At other points in the cycle, when we really see attractive investment opportunities, we'll tolerate more risk.
And you're running this in an investment trust structure. Does that give you more benefit, flexibility, etc., in terms of being able to implement this philosophy for clients?
Well, yes, definitely. The closed-end nature of an investment trust makes it easier to invest in smaller companies, for example, and you don't have to worry about cash flows. I think one of the sort of big unspoken truths of the industry is that when you have an open-ended fund and you have a lot of cash flows in or out of a fund, it can be really disruptive to actually generating returns, particularly if you become very successful, and there are some very large fund managers in the world. When you have very high cash flows into a fund relative to the size of it, you have to constantly deploy that capital, or in the reverse, you have to constantly be selling assets in order to meet redemptions, and that can completely undermine performance in a strategy. So having stable capital, whether it's just good long-term clients in an open-ended fund or a closed-end fund like Global Opportunities Trust, can be really helpful.
And when you're looking for ideas and deciding whether you want to add risk or you want to take risk away, who does that? How does that work? How do you work together? What team have you got around you that helps give you idea generation, etc.?
So I think you shouldn't separate the two, but just to try and answer the question, just to separate them a little bit. I think primarily when we're looking at, when Alan said there's not a lot of opportunities around, you can approach that from a range of angles. If you just aren't finding individual companies, that's a set of information. You can look at aggregate valuations relative to conditions and what you see happening. That's another set. And your degree of confidence rises as each of these ways that you look at it reinforces each other. If they're not reinforcing each other, then you need to go back and think about it all. And then the implementation is, if you are finding lots of good ideas, and it's consistent with everything else, then you're getting into the balance of what you put in and the risk reward associated with the drivers of them. And that's something Alan's got a long background in. And then the other part of this is what's been done at Goodhart in terms of having the talent to look at different segments of the market, because nobody's skilled at everything, in particular types of companies and regions. And what we've been trying very hard to do is bring in the top talent to look at each of those, to be able to, to put food on the table, which can then get put into the portfolio.
I think one of the things that's a bit unusual about Goodhart is that we when we have a global equity investment team of 9 people, and 9 very different people, and often what you get in a fund management company is that sort of everyone sort of thinks the same. You might all be value investors, or all growth investors, or all quality investors, to sort of oversimplify it. If we're aspiring to find investment ideas anywhere in the world, that's any country, any industry, any style, any type of situation as well. So you need different people, because any one individual has a limited range of investment sort of ideas and types of investment that they're comfortable with and expert in. So we have you can think of it as a melting pot, really, of very different people. And what that means for Sandy and myself is that there's constantly people around us that disagree with us, that have better ideas than we do, that have different ideas, and you need that kind of friction, because it's creative in terms of trying to think about how to manage a portfolio and where the ideas come from. And it's sort of essential to the idea of flexibility that sort of underpins the Global Opportunities Trust, is the idea that the exposure adapts over time depending on where the opportunities are. And Sandy and I are wired quite similarly, have very different backgrounds, but wired quite similarly. We have some people in the team that are wired quite differently as well. And
So when it comes to a stock, if someone says, I think there's a value opportunity here in this company in, I don't know, in Singapore or Japan or somewhere, and you look at it and go, I don't know if I'd agree with that. How does that play out in reality, whether it gets into a portfolio or not, and whether it's something that you end up investing in?
So I suppose this hypothetical company, the disagreement, if it would come, again, there's different levels of it. One of them is going through the numbers of why it's cheap. Where does the profit progression come from? Does that seem realistic, etc. And then the second is the drivers that are causing this to happen, which is where the debate will have been. But how similar are those drivers to other stocks that are in the portfolio, so that you get the right balance of risk reward within it?
When you want to have a lot more ideas than you have positions in a portfolio, because that friction is there. So one of the ways that we try to deal with that is sort of think thematically about the structure of the portfolio, because it's very easy to end up as like a stamp collector managing a portfolio. You find lots of things that sort of make sense individually, and you sort of buy them all because they sound like they're a great idea, and then you end up with a portfolio that's sort of incoherent, and it doesn't really tell a story. It doesn't have coherence in the exposures. It's just lots of stocks, and the problem with that is it becomes very difficult to predict how it's going to perform in different market environments, and it becomes very difficult to make changes to it in reaction to what's going on in markets and fundamentals. So we try and simplify things down to 6 to 10 themes that allow us to understand the story a portfolio is telling. And so to some extent, a new stock idea, if it could be a really good idea but not necessary for the portfolio, or it might dislodge an exposure or ultimately lead to sort of change in the structure of a portfolio. We have lots of stock ideas at the moment that we like, that make sense. Not so many that you might want to buy today, given our more macro views on what's going on in the world, but that's what you want. And then there's also a sort of vintaging sort of mindset to things of where do we want capabilities for the long term. So for example, at the moment we don't have very much technology exposure at all, which has been a good thing this year and not such a good thing last year. But we've hired 2 specialists, Russ Champion and Andrew Heap, that are fantastic in that space, because long term we are really interested in artificial intelligence, where it's all going, and we want Global Opportunities Trust to be exposed to good ideas in that space. It doesn't really play as much to Sandy and I's background, and we do sort of struggle with the valuations at times, but Andrew and Russ are fantastic investors in that space, and they'll be fighting to get stocks into the portfolio. At the moment, we don't have any exposure to that, so it's sort of redundant resource from a Global Opportunities Trust perspective. But in the future, we expect to have exposure in that area. I think it'll be a significant contributor to the real returns that it generates over the long term.
And you talked about it to a degree in terms of building that portfolio in a way that it's not just a great big massive random ideas. You're trying to make sure that it's got exposure to the themes that you believe in, that you've got the opportunities, etc. So when a new idea comes into the portfolio, is it one in, one out, or is it? And I suppose the other way of putting this question is, what causes a red flag for you in terms of selling a stock, getting it out of the portfolio?
I think a portfolio should breathe a bit, really. It's again, there's a sort of institutional construct that a portfolio should have sort of 45 to 50 stocks or whatever it is. But from an investment perspective, sometimes a bit more diversification makes sense. Sometimes more concentration makes sense. And so you need to have discipline. But when you have more ideas, then that's telling you something. And so the discipline isn't necessarily just having these arbitrary rules in the way that you structure a portfolio. It's being open to where the ideas come, and certainly when we find a theme, when we find an idea that is more than one stock, then clearly you're more likely to be buying multiple stocks in the portfolio. So we don't force ourselves to be one stock in, one stock out. We don't force the portfolio to be 100% invested in stocks. At the moment we're only about 60% invested, so we have plenty of cash and other assets to deploy when good ideas present themselves. So it's we're not 25 anymore, unfortunately. So having the experience to have discipline without having arbitrary rules is quite helpful. So.
But then directly on your question of the sell discipline, if you like, I mean, a lot of what we're doing, Alan would explain, is around change. You've found a company where something is changing or happening and the market hasn't recognised it. If you come to a view that the change you thought was going to happen, either the company's not implementing or the change is not happening, that would be a red flag. And the other thing that's not a red flag is that the company has changed, it's done what you expect, the market has recognised it.
It's now reflected.
Time to move on.
You have to have a really clear idea why everything's in a portfolio, and you don't have mission creep, if you like. If what you think was driving change doesn't happen, just sell it and move on. You don't have to be sort of emotional about it, really. But at the same time, you need to be patient and allow things to sort of play out. And getting the balance right is the sort of artistry of trying to manage a portfolio. We've gone for long periods of time with basically no turnover in Global Opportunities Trust, and other periods when there's quite a lot of turnover, when we're sort of repositioning things, and that feels like the right way of doing things rather than having a constant drip of change in a portfolio.
So that makes sense with your sort of view of having themes about things. What drives those themes? Is it what's going on in macro? Is it what you see at bottom up, or is it a combination of all of the factors out there? How do you settle on, I don't know, half dozen, 8 themes in the portfolio that you're trying to get exposure to?
I mean, the basic building block of what we do is trying to find stocks. And we're looking for change. We're looking for change across lots of different types of stocks in every industry and country in the world. There's definitely a capital cycle element to the way that we think, and you can think of it as being, you can have change that is within a company, so like restructuring, a spin-off, something like that, or change in the environment in which a company operates, so outside of the company, so in the industry that it operates. And oftentimes the best investment ideas involve change in both of those places. So you have change within companies that's driven by change in the environment in which a company operates, and in simple terms a theme often comes out of that. So think of the oil industry, for example. When the oil price is high, often oil companies decide to go and dig lots of holes in the ground and waste a lot of money coming up dry, trying to find new supply of oil. But in the environment that we've been in recent years, that hasn't happened so much, because the sort of climate change theme that's dominating markets means that people don't expect to be using as much oil in the future. So oil companies haven't been digging so many holes, which means they're more profitable than they would normally be. And so there's change in companies there in the way that they deploy capital that's a function of change in society. And change in many ways is the lever through which you can create sort of asymmetry in a portfolio. I think like the defence industry, for example, defence stocks are industrial cyclicals, so tend to not be very defensive in an economic downturn.
Yeah.
But when you have a structural shift in demand for the product of a defence company, in this example, the risk and return of those kind of companies in aggregate changes, so they become a bit more defensive in a down market, for example, and that makes them much more valuable in a portfolio. So focusing on change really allows you to focus on the things that can create asymmetry in a portfolio. Japan would be another good example of where corporate governance reform in Japan to some extent sort of underpins the valuation of companies because they're optically very cheap. But you need a catalyst in order to drive the share price up. You have a very long tailwind catalyst in Japan of corporate governance reform encouraging companies to normalise their balance sheet. So you saw last week the chairman of Toyota Motor Company announced that Toyota was looking at buying out one of its subsidiaries, Toyota Industries, for example. Toyota Industries is actually the original Toyota company. It's that kind of thing that creates asymmetry in the return, and being willing to predict change in a portfolio is a difficult emotional thing, and creating an investment environment in which people are willing to predict change because you can be wrong is important. And if all you do is react to news that everyone else knows, you're never willing to sort of stick your neck up and say, I think this is going to change when there isn't clear evidence or proof that you're right, is difficult, like for anyone. And if you work in an environment where people are picking on each other and looking for weakness, if you like, that you just don't do interesting things. So as a sort of fully employee-owned partnership, if you like, at Goodhart, we just have a very different culture. So we kind of celebrate innovation and trying to find new ideas.
I think the other thing to say is, sometimes it's semantics and how you describe things, but change doesn't happen in isolation. So you can call it a theme or you can call it a cluster. But they're all experiencing the same environment, and if it's changing, so you're going to see it popping up. So you can describe it as a theme, which means you're telling a story about it. And the benefit of that is, if you're going to tell a story, it has to be coherent. You have to be able to understand it. And if you can, then it's much more likely to be true because you're seeing the things that are happening. So, but it's always difficult because sometimes you say thematic, people are like, well, does that mean you haven't really looked at it? It doesn't mean that at all. You're just trying to explain it in a coherent, consistent manner, which then allows you to consider how these things will react if the environment changes, the market environment or whatever it is. So you add that together, you've got a view of how the portfolio will react as the world evolves, and I think that's really helpful for having a clear view of what the portfolio is about and where it's going.
And it's also, if you think about a traditional global equity strategy, is going to start with the mindset of the neutral position is owning everything in an index, if you like. Whereas Global Opportunities Trust is focused on generating absolute returns over the long term. So we don't think about the composition of any market index as being the safe asset. The safe asset is cash. And so how do you structure a portfolio when you're not using the market as the crutch? And so if you focus on how clusters, how themes influence groups of stocks and how they combine in different scenarios to generate an absolute return, that provides another mechanism for structuring a portfolio, basically, rather than I want to own some banks because there's a lot of banks in an index. That doesn't make sense from an absolute return perspective at all.
And I'm just going to touch on, you had your full year results last week, was it the week before? It was the last couple of weeks they were announced. Up 4.1% for the NAV, so positive return for investors. You've doubled the dividend, gone from 5p to 10p. That dividend progression, I mean, that's a bit of a change. For the last 3 years it's been static at 5p. What's driven that and what drove your performance last year?
Why don't you pick up the performance and I can go to the dividends?
Well, the performance last year was sort of disappointing, to be honest. A long way behind markets. So we might say that we're absolute return, but we're not immune to opportunity cost. The portfolio was too defensively positioned given what happened in markets. We've been somewhat vindicated this year because the trust's NAV is up a little absolute this year, and obviously global equity markets and the US in particular are down significantly. So, I think that tells you a lot of things about performance and track records, really. When you decide to start and stop the clock, you can either feel
12 months.
clever or dumb, depending on which day of the week you look at things. Our view has just been that the tortoise beats the hare with this, and that valuations and the opportunity set that we can identify just doesn't justify taking on more risk. And so we're pleased to generate an absolute return last year, but clearly in retrospect you can always think of things you could have done that would have made a better return. If we had changed the way that the portfolio was positioned radically last year, we would have done a lot worse this year. So it's, you have to be careful of change, and you've got to be willing to make it, and you've got to be flexible, but you've got to be thoughtful about it. On the dividend itself, I'm not on the board, you are.
So I think the answer there is that when we first started the trust in 2003, we didn't want to be tied to a level of dividend or progression, because we were trying to retain the flexibility within the trust. So you weren't going to be, I've got to buy some income stocks because I haven't generated nothing. Well, there's a couple of things that have happened since then. One, there's more flexibility in where the dividend derives from, but two, we've got significant reserves, dividend reserves. So the dialogue with shareholders suggested that they would like a bit more income, particularly if you're waiting for returns to come. So there was no real constraint on us doubling the dividend. There's plenty of headroom there, and so it was a mixture of, it won't inhibit our flexibility, number one. Number two, we've got the reserves to do it. Number three, there seemed to be some meaningful shareholder desire for us to do it, and obviously we're all shareholders, so we want to make this attractive for shareholders.
And it's yielding about 3.25% or something now.
That,
Good. Okay, I'm conscious that we've talked a lot about the portfolio, about the philosophy, etc. I'm going to ask you just a couple of final questions, sort of about you as portfolio managers, in terms of what have you learned, and I think we probably touched on some of this over the course of the discussion, but what have you learned as a portfolio manager in terms of experience, both good and bad, things that you should do as a portfolio manager, things you should avoid as a portfolio manager, and how does that fit into your day-to-day thinking?
That sounds like another book for Sandy.
I think you don't want to be too introspective, but I think if you look back, understanding where your skill sets are, and then seeking out people who've got complementary skill sets, and that ranges, if you take running investment teams, some people are very good at analysing a particular type of company, even within a style, some, but not in others. And if you get those mismatched, you start to have issues. Many people are good at finding ideas, but not good at putting together risk-reward in a portfolio. So, I think you understanding your own limitations and then finding incremental skills to overcome your gaps is probably the single most important thing, because that then allows you, because having a good idea is fine, but if you can't implement it properly, either individually at a company level or in terms of getting the right risk-reward balance, that's really annoying. And I think so when Alan and I discussed, I kind of recognised that with Alan's history and background, a lot of portfolio managers, forgive me, are not that good at structuring their portfolio. He brought a skill set and an understanding of risk that I felt that whatever I did would be implemented better with his guidance and input, or just doing it. And then the second piece was, looking back at your own returns, how much of that was driven by your innate biases, which you took to be skill at the time, and how much of it was your incremental, what you added incrementally. And then when you understood those things, that brought you to what Alan's been creating at Goodhart, is to have the individual tools to allow you to do those things, and then create an environment where it all works in a consistent fashion. And that's what's the most exciting, thing about this. It's not easy to do, because you need not people that think the same way, but like-minded about the desire to have information and conversation with people whose biases are different.
Alan?
I think there's a humility that you need as a fund manager. Clearly you need to believe in what you do, but there's a humility to understand, to be honest, just how little you do that really adds a lot of value. And that's a liberating thing when you sort of wrap your head around that, because often, it's very easy for a fund manager to spend a lot of time doing things and being active on doing things that really don't add any value for anyone, and it makes you feel like you're busy. But if you spend too much time focusing on all the things that aren't really going to add any value, you can often miss the really big things. And every now and again, you need to get something right, something big right to manage a portfolio effectively. And you really can think of it as 95% of the time what a fund manager doesn't really add any value, doesn't really detract. And 5% at most of the time, the decision that you make needs to be right. And trying to focus in on when you're making one of those decisions rather than one of the 95% that don't, or getting balance so that you just don't waste a lot of time on the things that are all just noise, to give yourself the bandwidth to focus on the things that can actually add value. I think that's one of the things that I've learned in the last 30 years, that the hard way probably, as much as anything.
So keeping level-headed, humility, making sure you understand what your capabilities and limitations are and where you're adding value, and then knowing what your skill set is and how to build a team around you with the right skills to complement your skill set. Probably the two takeaways from that.
Yeah, sounds fair.
Sounds fair.
Again,
Good.
You've done a better paraphrase of what we said.
Listen, gents, I think we could carry on talking for ages, but I'm conscious of your time, so thank you very much indeed for your time and for your insights. I'd like to thank, on behalf of the listeners and viewers, Sandy and Alan for their time at Goodhart Partners, and we look forward to seeing how the Global Opportunities Trust progresses in the future.
Thank you.
Thank you very much.
Thanks, gents.
Cheers.
The podcast is issued by the Investing Collective Ltd, a company which is registered in England and Wales, number 149104551. The Investing Collective makes no warranties or representations regarding the accuracy or completeness of the information contained in the podcast. This information represents the views of the interviewer and the interviewees at the date of issue, but that may be subject to change without reference or notification. The Investing Collective does not offer investment advice nor make recommendations regarding investments. The content of this podcast is not deemed to constitute financial or investment advice in any way and shall not constitute a regulated activity for the purposes of the Financial Services and Markets Act 2000. This podcast shall not constitute nor be deemed to constitute an invitation to induce an individual to engage in an investment activity. And should you decide to make any investment decisions based on the information contained in the podcast, you're advised to seek appropriate advice before taking those actions, and you do so at your own risk. Thank you for listening.